The Supreme Court just struck down the administration's emergency tariff mechanism. Markets immediately reacted. Silver dropped to $79.80, and then something extraordinary happened. Within the same trading session, silver reversed violently and rallied all the way back to $84. That is a 4+ recovery from what should have been crushing negative macro news. When an asset absorbs a negative headline, flushes lower, and then reverses aggressively in the same session, that is not normal market behavior. That is a market telling you something about underlying demand that the headline could not suppress. And when you look at what is happening beneath the surface in the physical silver market right now, the story becomes even more remarkable. COMEX registered silver inventory now sits at 88.19 million ounces. Over the past 30 days, 51.9 million ounces have been drained from COMEX vaults. That is a 12.4% monthly decline in physical inventory. The coverage ratio, registered silver relative to open interest, has collapsed to 0.4, and UBS is now projecting a 300 million ounce structural deficit for 2026, which would be the 6th consecutive year of deficit and 2.5 times larger than the 2025 estimate. Meanwhile, gold just posted a historic weekly close at $500, the first weekly close above that level in history. The dollar had its strongest week in months, and yet silver, after absorbing a Supreme Court ruling that removes a major trade policy tool, reversed from its lows and closed the session significantly higher. Now, let me walk you through what this all means, because the convergence of physical drainage, institutional deficit forecasts, historic gold breakouts, and silver's refusal to stay down is painting a picture that the paper market may not be able to suppress much longer. Emergency tariff mechanism struck down. 150B refund risk. Let's start with the macro catalyst that triggered today's price action. The Supreme Court struck down the administration's emergency tariff mechanism. This is significant because it removes the executive branch's ability to implement rapid, broad-based tariffs without going through more extensive legislative or regulatory processes. The immediate financial implication is that up to $150 billion in potential tariff refunds could now be on the table if companies that paid tariffs under the emergency authority challenge those payments. That is not a small number. If even a fraction of that becomes legally enforceable refunds, the U.S. government would need to find additional borrowing capacity to cover it. More borrowing means more debt issuance. More debt issuance means more Treasury supply hitting the market. More Treasury supply in an environment where the U.S. is already projected to add $2.4 trillion per year to the national debt creates pressure on bond markets, upward pressure on yields, and, critically for precious metals, increased concerns about the long-term sustainability of dollar-denominated debt. But here is what the market may have missed in the initial reaction. The Supreme Court ruling does not eliminate trade policy tools entirely. It only removes the emergency mechanism. Sections 232 and 301 of existing trade law remain legally intact. Section 232 allows tariffs based on national security considerations. Section 301 allows tariffs based on unfair trade practices. Both of those pathways are still available to the administration. They just require more procedural steps and cannot be deployed as rapidly. So while the headline reads as a major policy defeat, the underlying trade policy uncertainty has not been eliminated. It has simply been shifted to different legal mechanisms. Markets hate uncertainty. And what this ruling creates is not clarity, but a more complex and slower-moving tariff environment where outcomes are less predictable. That is the macro backdrop. Now let us talk about why silver dropped to $79.80 on that news, and then why it violently reversed to $84 in the same session. When paper sellers meet physical buyers. Silver hit an intraday low of $79.80 immediately following the Supreme Court headline. That was the knee-jerk reaction, trade policy, uncertainty, potential dollar strength from reduced tariff implementation, general risk-off positioning. The paper market did what the paper market does. It sold first and asked questions later. But then something happened. Within the same trading session, aggressive buying emerged and drove silver all the way back to 84. That is a 4+ recovery, a 5% intraday rally from the lows. And it happened on a day when the macro headline was unambiguously negative for risk assets and commodities. When an asset absorbs negative news, sells off, and then reverses that sharply in the same session, it tells you one of two things is happening. Either short covering is being forced by technical levels, or real physical buying is overwhelming paper selling pressure. In this case, the evidence points strongly toward the latter. The reversal occurred precisely at a technically significant level. The 3-SAR AM New York Time hourly candle was identified by traders as a key support zone. When silver dropped to $79.80 at 10 AM New York Time, it bounced exactly from that prior candle's low. That is not random. That is algorithmic or institutional buying, sitting at a predefined level, waiting for price to come to them, and then stepping in with size. But the more important question is, why was there buying at that level in the first place? Why didn't silver just continue lower into the close if the macro news was so negative? The answer lies in what is happening in the physical market right now. And that story is stunning. Registered silver collapses to 88.19 mid-hours Oz. Coverage ratio 0.14. COMEX registered silver inventory, the metal that is actually available and earmarked for delivery, now stands at 88.19 million ounces. That number is down 51.9 million ounces over the past 30 days. That is a 12.4% decline in available physical inventory in a single month. Let that sink in. In 30 days, more than 1/10 of the COMEX's deliverable silver has left the vaults. This is not a forecast. This is not a projection. This is reported data from the exchange itself. Physical metal is being removed at a rate that has rarely been seen in modern COMEX history, and the drain is not slowing down. In the most recent trading session alone, another 1.4 million ounces were withdrawn. That is 1.4 million ounces in a single day. At this pace, if the drain continues uninterrupted, COMEX registered inventory could fall below 70 million ounces within weeks. Now let's talk about the coverage ratio, because this is where the numbers become genuinely alarming. The coverage ratio measures registered silver inventory relative to open interest in silver futures contracts. A healthy, well-supplied market typically has a coverage ratio above 0.30 or 0.40, meaning there is enough physical metal in the vault to cover 30 to 40% of outstanding paper contracts if a significant portion stood for delivery. The current coverage ratio is 0.14. That means there is only enough registered silver in COMEX vaults to cover 14% of open interest. Put another way, if just 15% of open interest decided to stand for delivery, the exchange would not have enough metal to fulfill those contracts at current inventory levels. Historically, delivery rates in silver futures run around 5%. But in recent months, we have seen delivery rates climb to 10, 12, even 13% as physical demand has surged, and Eastern buyers have increasingly taken delivery from Western exchanges. If that trend continues, and there is no reason to believe it won't given the structural deficit dynamics we are about to discuss, the COMEX could face a genuine inventory crisis. This is not speculative fear-mongering. This is basic arithmetic. When you have 88.19 million ounces of registered inventory and a coverage ratio of 0.14, you are operating with very thin physical margins. And when 1.4 million ounces are leaving the vault in a single day, those margins are getting thinner in real time. Now add in the fact that silver just reversed $4 higher in a single session after absorbing negative macro news. That reversal was not driven by headlines. It was driven by buyers who understand that physical metal is becoming harder to source at current paper prices. And those buyers stepped in at $79.80 because they know what the supply situation looks like, and they know it is about to get a lot worse. Structural deficits are compounding, not resolving. UBS, one of the largest and most credible institutional voices in precious metals research, has just released a projection for silver in 2026. They are forecasting a 300 million ounce structural deficit. For context, global annual silver mine production is approximately 800 million ounces. A 300 million ounce deficit represents nearly 40% of total annual production. That is not a marginal supply shortfall. That is a structural imbalance where demand is overwhelming supply by nearly half. And this is not a one-year anomaly. If UBS's forecast proves accurate, 2026 will be the 6th consecutive year that silver has been in structural deficit. 6 years, and yet the price, driven by paper futures markets, has been repeatedly suppressed before it can fully express that underlying physical reality. Even more striking, UBS's 300 million ounce deficit projection for 2026 is 2.5 times larger than their estimate for 2025. The deficit is not stabilizing, it is accelerating. The answer is simple. Industrial demand for silver is structural and non-discretionary. Solar panel production requires silver. There is no substitute that works at scale. Electric vehicle production requires silver. These are not optional inputs that can be engineered away if the price rises. At the same time, global mine production has been relatively flat for years. There are no massive new silver discoveries coming online. Existing mines are being depleted, and the lead time to bring a new silver mine from discovery to production is measured in decades, not years. So you have structural, non-discretionary industrial demand that is growing every year as the energy transition accelerates. You have relatively flat mine supply, you have 6 consecutive years of deficits, and you have a 300 million ounce projected deficit for 2026 that is 2.5 times larger than the prior year. That is not a supply-demand imbalance that resolves itself. That is a supply-demand imbalance that eventually forces a price reset, because at some point, industrial buyers cannot secure the metal they need at current prices, and they are forced to bid higher. And we are already seeing evidence of that. Industrial buyers are calling mine CEOs directly and offering 20% premiums above spot to secure supply outside of exchange pricing. Samsung has reportedly executed direct deals. The physical market is bifurcating from the paper market because the paper price no longer reflects the true cost of securing physical metal. Gold just posted a weekly close at $5,100. This is being framed as a historic event because it represents the first weekly close above $5,100 in the entire history of gold trading. Weekly closes matter more than intraday highs because they represent sustained positioning rather than temporary spikes. Earlier this year, gold touched an intraday high of $5,600. That was a spike, a moment of extreme stress or momentum that pushed prices temporarily higher before reversing. But a weekly close at $5,100 is different. A weekly close means that professional money, institutional positioning, and algorithmic strategies have all collectively decided that $5,100 is an acceptable level at which to hold positions over the weekend. That is conviction, not panic. Gold at $5,100 also represents a structural breakout above psychological resistance. When an asset clears a major round number and then closes a full trading week above that level, it typically signals that the next leg of the move is beginning. The $5,000 level was a magnet for months. Price would approach it, reject, and pull back. Now that level has been cleared and held on a weekly basis, the path of least resistance is higher. But the more important question is, why is gold breaking out now? What is driving institutional demand for physical gold and gold-backed assets at levels that produce historic weekly closes? The answer is the same force that is driving silver's refusal to stay down despite negative headlines: systemic financial stress and currency debasement concerns. Total debt is projected to hit $64 trillion by 2036, which could add up to $150 billion in refund liabilities that require additional borrowing. Big tech credit default swaps have surged 400% in the past 13 months. Bitcoin ETFs have seen 4 consecutive weeks of outflows, suggesting institutional money is rotating out of speculative digital assets and into hard money. Gold at $5,100 is not a speculative bubble. Gold at $5,100 is institutional capital, recognizing that the trajectory of sovereign debt, currency debasement, and financial system leverage is unsustainable, and positioning accordingly. And when gold breaks out structurally, because of its smaller market size and dual role as both a monetary metal and an industrial commodity. Now let's address the elephant in the room. The US dollar just posted its strongest week in months. Normally, a strong dollar is a mechanical headwind for precious metals because commodities are priced in dollars globally. When the dollar strengthens, commodities typically weaken in dollar terms, even if their value in other currencies remains stable. So the fact that silver dropped to $79.80 on the Supreme Court news is not surprising given the dollar strength backdrop. That is not normal behavior. That is a market telling you that underlying physical demand is strong enough to absorb dollar headwinds and negative macro headlines simultaneously. There's also a deeper issue at play here. But why did the dollar strengthen? But that same ruling also creates $150 billion in potential refund liabilities, which requires more government borrowing, which eventually undermines dollar confidence if the trajectory is not sustainable. In other words, the dollar strength this week may be a short-term technical reaction to reduce tariff risk. But it does not change the long-term structural picture. The US is on an unsustainable debt trajectory, currency debasement is baked into the fiscal outlook, and real assets like gold and silver are the logical hedge against that trajectory. So while the dollar strength is worth noting as a near-term headwind, in fact, if metals are holding up this well while the dollar is strengthening, because the structural drivers of dollar weakness, debt accumulation, fiscal deficits, monetary expansion, have not changed. The convergence of signals that cannot be ignored. Let's bring this all together because the convergence of signals right now is genuinely extraordinary. You have COMEX registered silver inventory collapsing by 51.9 million ounces in 30 days, a 12.4% monthly decline. You have 1.4 million ounces leaving the vault in a single trading session. You have a coverage ratio that has fallen to 0.1, meaning there is only enough physical silver to cover 14% of open interest if delivery demand surges. You have UBS projecting a 300 million ounce structural deficit for 2026, the 6th consecutive year of deficit and 2.5 times larger than 2025. You have industrial buyers bypassing exchanges and paying 20% premiums to secure physical supply directly from mines. You have silver absorbing a negative Supreme Court headline, dropping to $79.80, and then reversing $4 higher in the same session to close at $84. You have gold posting a historic weekly close at $5,100, the first weekly close above that level in history. You have the dollar posting its strongest week in months, and yet silver still closed higher after the reversal. You have trade policy uncertainty persisting via Sections 232 and 301, even though the emergency mechanism was struck down. You have $150 billion in potential tariff refund liabilities that could require additional government borrowing. Every single one of these data points in isolation is significant, but when they converge simultaneously, they paint a picture of a market where physical reality is beginning to overwhelm paper pricing mechanisms. The paper market can suppress price in the short term through futures selling, margin increases, and narrative control. But the paper market cannot create physical silver that does not exist. And right now, physical silver is leaving COMEX vaults at a pace that suggests someone with very deep pockets and very good information believes that metal will be worth significantly more in the near future, or that it simply will not be available at current prices. The signals that will tell you if this is real. So what do you watch between now and the next major delivery cycle to understand whether this physical versus paper divergence is accelerating or stabilizing? First, watch COMEX registered inventory daily. If the drain continues at the current pace, 1 to 2 million ounces per day, registered inventory could fall below 70 million ounces within weeks. If inventory stabilizes or rises, it suggests the pressure is easing and the paper market has regained control. Second, watch the coverage ratio. If it falls below 0.12, you are in genuinely unprecedented territory where the exchange has less than 12% physical coverage for open interest. At that point, any surge in delivery demand becomes a structural crisis. Third, watch silver's reaction to negative headlines. Today's $79 to $84 reversal is a powerful signal. If silver continues to absorb bad news and reverse aggressively, it confirms that physical buyers are stepping in at every dip and that the paper market's ability to suppress price is weakening. Fourth, watch gold's weekly closes. If gold holds above $5,100 on a weekly basis and continues grinding higher, it confirms that institutional money is positioning for a sustained precious metals bull market. Gold leads, silver follows, often with more explosive upside. Fifth, watch for institutional confirmations like the UBS deficit forecast. When major banks start publishing structural deficit projections of 300 million ounces, that is not speculative analysis. That is institutional positioning being telegraphed to clients. If more institutions follow UBS with similar projections, it accelerates the narrative shift from silver is oversupplied to silver is structurally undersupplied and mispriced. Is physical finally crushing paper? Here's the question that matters. At what point does the physical market overwhelm the paper market's ability to set price? At what point does the fact that COMEX registered inventory is collapsing, that industrial buyers are paying 20% premiums, that UBS is projecting a 300 million ounce deficit, and that silver is reversing four higher on negative news? Days. At what point do all of those signals add up to a price reset that the paper market cannot suppress? We do not know the answer to that question yet, but we do know that the conditions for such a reset are building in real time. The vault drain is measurable. The deficit projections are coming from institutional sources. The coverage ratio is at historic lows. And silver's price action is increasingly divorced from the macro headlines that would normally drive it lower. The Supreme Court ruling removed one policy tool but did not eliminate trade uncertainty. The dollar had its strongest week in months, but silver still reversed higher. Gold closed at a historic weekly level above $5,100, while silver bounced from 79.80 to 84 in a single session. And all of this is happening while 51.9 million ounces of physical silver have left COMEX vaults in 30 days. Physical silver is becoming harder to source at paper prices. That is not speculative analysis. That is observable reality. Industrial buyers are bypassing exchanges. Coverage ratios are collapsing. Vault drains are accelerating. And the paper market, despite throwing everything it has at silver, negative headlines, dollar strength, margin increases, futures selling, cannot keep the price down for more than a few hours before physical buyers step in and reverse the move. Is physical crushing paper? Not yet. But the evidence is mounting that the paper market's control is weakening, and that when the physical market finally takes over price discovery, the move will be violent, sustained, and unlike anything we have seen in the modern silver market. Watch the vaults, watch the coverage ratio, watch the delivery rates, and understand that in the market, for real money, the most important price is never the one on your screen. It is the price at which you can actually get metal delivered into your hand. That price is rising, and the paper market is running out of tools to stop it.